Welcome back to Evergreen Report, your trusted source for insights on finance, business, tech, and investing. Today, we're tackling a topic that's been making waves in the markets: Donald Trump's latest tariff measures. If you're an investor, you're probably wondering how these tariffs, especially those affecting agriculture, could shake up your portfolio. More importantly, you're likely asking, what can I do to safeguard my investments? In this video, we'll break down Trump's tariff measures, explore their potential impact on the agricultural sector, and share 6 actionable investment strategies to help you navigate these uncertain times. Whether you're a seasoned investor or just getting started, these strategies will equip you with the tools to manage risks and uncover opportunities. Before we dive in, grab our free ebook, Investor's Manual, a comprehensive guide to valuation, linked in the description below. It's packed with tips to sharpen your investment skills, especially in volatile markets like this one. Let's get started. So, what are these tariff measures all about? As of early 2025, President Donald Trump has rolled out a 10% additional tariff on imports from China and a heftier 25% on goods from Mexico and Canada. These tariffs, effective since February 2025, aim to tackle issues like illegal immigration and drug trafficking. But while the intent may be political, the economic fallout, particularly for agriculture, is undeniable. China, Mexico, and Canada are linchpins in U.S. agricultural trade. China devours U.S. soybeans and corn, Mexico supplies much of our fresh produce, and Canada is a vital two-way trade partner. Trump's tariffs are like tossing a stone into a calm pond. The ripples could disrupt this delicate balance. Higher tariffs on imports might give U.S.-grown products an edge, but retaliatory tariffs from these countries could choke U.S. farm exports. Take China, for instance. If they slap tariffs on U.S. soybeans and corn, exports could plummet, potentially by 52% for soybeans and 84% for corn, according to recent estimates. That's a massive hit to farmers and the companies tied to those exports. Falling exports mean falling commodity prices, which could send shockwaves through the agricultural sector. For investors, this spells volatility and risk, but also opportunity, if you know how to play it right. Let's zoom in on how these tariffs could rattle agriculture. First, the downside. Retaliatory tariffs from China, Mexico, and Canada could slash demand for U.S. farm exports. Soybeans and corn are in the crosshairs, but dairy, pork, and other products might feel the pinch too. Lower exports translate to lower prices, squeezing farmers' incomes and the companies that process and sell these goods. But there's a silver lining. Higher tariffs on imports from Mexico and Canada could make U.S.-produced goods, like fresh fruits and veggies, more appealing to buyers. If Mexican avocados or Canadian dairy get pricier, U.S. farmers might see a demand bump. That said, it's not a slam dunk. Scaling up production takes time, and many crops are seasonal, so the gains might be limited. In essence, agriculture faces a double-edged sword: potential wins from import substitution but serious risks from export losses. As an investor, you need to brace for both. Now, let's get to the good stuff. How can you shield your investments from this turbulence? We've lined up 6 strategies to help you manage risks and spot opportunities. Here they are, step by step. 1. Diversification. Spread your risk. Diversification is a timeless strategy, and it's your first line of defense. By spreading your investments across different sectors, you limit your exposure to any one industry's woes. With agriculture under pressure, look to sectors like tech, healthcare, or consumer goods. Companies like Apple or Johnson & Johnson, with strong domestic and global footprints, aren't as tied to trade disputes. A balanced portfolio can soften the blow if agriculture stumbles. 2. Hedging. Protect against price drops. Hedging might sound fancy, but it's just a way to insure your investments against losses. Worried about falling commodity prices? Use tools like futures contracts or options to lock in prices or cushion declines. For example, if you own stock in a soybean-heavy company, buying soybean futures could offset losses if prices tank due to China's tariffs. It's not a perfect shield, but it's a smart way to manage volatility. 3. Focus on domestic-focused companies. Not all agricultural firms are at the mercy of global trade. Some focus on the U.S. market, making them less vulnerable to export hiccups. Take Land O'Lakes, a dairy powerhouse with deep domestic roots. If American dairy gains ground over Canadian imports, companies like this could thrive. Seek out firms with high domestic revenue or products that face little international rivalry. 4. Capitalize on substitution benefits. Here's an intriguing angle. If tariffs jack up the cost of imported goods, U.S. companies making similar products could see a demand surge. Picture fresh produce. If Mexican avocados get pricier, U.S. players like Dole or Caliva growers might step up. Supply limits could cap the upside, but firms producing substitutes for imports could be dark horse winners in this trade spat. 5. Invest in value-added agricultural products. Raw commodities like soybeans and corn are price-sensitive, but value-added products, like processed foods or specialty crops, are more resilient. Companies like General Mills or Kellogg's, which turn raw materials into branded goods, often hold steadier margins when prices swing. Their focus on processing and innovation makes them less dependent on raw commodity volatility. For stability, this is a solid bet. 6. Monitor government support. Don't sleep on government action. In Trump's first term, aid packages propped up farmers during the China trade war. History could repeat itself. If subsidies or support roll out, they could steady farmer incomes and bolster related investments. Watch policy updates closely. Agricultural ETFs like DBA, which tracks commodity prices, could benefit from such moves. Let's ground these strategies with some examples. Take Archer Daniels Midland, Admiral, a soybean giant. With China as a major market, Admiral is exposed to tariff retaliation. If you hold ADM stock, hedging with soybean futures could guard against a price drop. Contrast that with Dole, a U.S. fresh produce leader. If tariffs hike the cost of Mexican imports, Dole might see a demand boost for its homegrown goods. But since produce is seasonal, its ability to scale up could be constrained, something to weigh carefully. In dairy, Dean Foods could gain if Canadian imports get pricier, lifting demand for U.S. milk. Yet, if Canada fires back with export tariffs, those gains might shrink. It's a tightrope, underscoring why diversification and hedging matter. Conclusion and call to action. There you have it. 6 strategies to weather Trump's tariff measures. Diversify your portfolio, hedge against volatility, target domestic companies, tap substitution benefits, invest in value-added products, and track government support. Investing in shaky times can feel overwhelming, but with these tools, you can protect your wealth and even grow it. For more insights, subscribe to Evergreen Report and hit the bell icon to stay in the loop. And don't miss our free ebook, Investor's Manual, a comprehensive guide to valuation, linked below. It's your roadmap to smarter investing, no matter the market. Thanks for watching, and we'll catch you in the next one.